investors watching Your Money. Joining me right now is Michael Lee Strategy founder Michael Lee, Bulltick Capital Chief Market Strategist Catherine Rooney-Avira, and Strategic Wealth Partners CEO Mark Tepper. Great to have everybody this morning. Mike, kicking things off with you with a nice, strong rally underway this morning. Riddle me this, Mike. What the heck? JP Morgan CEO Jamie Dimon is reportedly working with other big bank CEOs to craft a new rescue plan for First Republic Bank. One option on the table is a capital raise. You've got officials now studying ways that the FDIC could expand to cover all deposits lost in the banking crisis, Mike. And then, of course, you've got worries about the Federal Reserve rate hikes that are continuing to slow the economy. And we're expecting another one tomorrow. And what do we have on Wall Street? A market that's up 300 plus yesterday and 250 right now.
Yeah, Maria, I think this banking crisis is one of confidence, more so than structural issues. I think you had some very unique issues at Silicon Valley Bank that have bled across into a few other banks that were in this venture lending space. But beyond that, there's a lot of structural changes that have happened since 2008. Okay, obviously Credit Suisse has been in some trouble for a long time. That bank existed as a trading operation, and based on capital requirements and the trading environment, made it very difficult for them to exist going forward. Whereas a lot of these other large mega banks don't lend unsecurely to other banks the way they used to because of the capital requirements. Most of the interbank lending that's going on is through repurchase agreements or asset-backed loans. However, no matter how good the banking laws are, no matter how good the oversight is, no matter how strong your balance sheet is, nobody can withstand a 20 to 25% deposit-based withdrawal in a single day, as happened with Silicon Valley Bank. So I think the upshot of what just happened is lending standards are most likely going to increase, further slowing the economy, because the problem is if the Fed can no longer raise rates due to this banking crisis and inflation stays persistently high. Over the last few months, we have seen core services minus housing remain above 5%. Now, that's Jerome Powell's key indicator that he talks about looking at. So if the Fed can't keep rates high, if they can't keep raising as they need be, and we have persistently high inflation, we are in a very, 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 very dire situation. So I think the Fed goes 25 basis points. I think how the market reacts depends 100% on what Powell says and reacts to the questions and how the market absorbs that. What I see is not so much as a contagion from banks or some sort of massive solvency crisis. It's what do we do if the Fed can't raise anymore, can't keep tightening, and has to ease so that there's no systemic shocks from the banking system.
Yeah, I mean, I think, Catherine, this two-day meeting is kicking off today, and it's all